Good morning, everyone. We are pleased to welcome you all today to this webinar on Indian Budget 2023. I'm Navita Meyer and I lead FICCI in Southeast Asia, based in Singapore. This annual session, led by Dhruva advisors, supported by High Commission of India in Singapore, FICCI and SICCI, has become an important engagement on our annual calendar. I must thank Deputy High Commissioner, Mr. Siddharth Nas, for joining us today. The High Commission of India has been an ardent supporter for this session over the last 2 years, and Dhruva Advisor has been very consciously leading this initiative in the last few years. To start off the session, I would also like to take this opportunity to introduce the key guests that are here with us today. We are honored to have the presence of the Deputy High Commissioner, Mr. Siddharth Nath from the High Commission of India in Singapore. Mr. Dinesh Kanabar, CEO, Dhruva Advisors, who is also the chairperson for the FICCI Taxation Committee. Dinesh ji is also the winner of the Asia Tax Practice Leader of the Year 2020 and is a stalwart in the industry and has been over the decades been recognized as amongst the top tax advisors in India. Mr. Mahir Gupta, partner Dhruva Advisors Singapore, based in Singapore, who has 2 decades of experience advising clients from various industries on a wide range of international and local tax issues. We also have with us Mr. Neeraj Bagri, partner in Direct Taxes, Dhruva Advisors Singapore. Neeraj is a member of ICAI and has more than 18 years of experience in the field of indirect tax advisory, consulting, and litigation. Once again, I formally welcome all of you, including all the senior panelists and the Deputy High Commissioner, to this session here today. Just to give a few opening remarks for this session before we move forward and invite the Deputy High Commissioner to present his opening remarks for this session. The Budget 2023 presented by Finance Minister Nirmala Sitharaman and her team has been lauded by FICCI in India as an outstanding budget that is considered balanced, growth-oriented, and progressive. And it lays due emphasis on inclusiveness and sustainability. The budget proposals reflect government's intent and commitment towards Atmanirbhar Bharat and government's vision for Amrit Kaal. The term Amrit Kaal, as first used by Prime Minister Narendra Modi in 2021, when he revealed a unique roadmap for the country for the next 25 years from India at 75 to India at 100. The objective of Amrit Kaal being enhancing the lives of the nationals of India, reducing the divide in development between villages and cities, lessening the government's interference in people's lives, and embracing the latest technology. And true to this vision, the Union Budget 2023 has committed an unprecedented outlay on infra capex, laying thrust on embracing technology, digitization, and modernization of regulations in the financial sector, amongst other initiatives. The budget proposals are expected to strengthen the fundamental pillars of economy, ensuring manufacturing competitiveness, ease of doing business, and a robust ecosystem for research and innovation. We see a clear intent, right proposals, and matching allocations in many areas that would contribute to achieving New India's vision. Digital infrastructure has been the backbone of New India's success. We've seen how digitization has been a steady theme of the government and has enabled India's transformation into a leading digital economy in the world. The unique capabilities we have developed out of digital stack, creating efficient service delivery platforms, be it financial payments, COVID vaccinations, e-marketplace, and so on, are now being extended to agriculture through the proposed Agri-Stack, which will go a long way in addressing the challenges of Indian agriculture sector by ensuring better access to inputs, credit, insurance, as well as market intelligence. The government has also placed a huge thrust on enabling ecosystem for research and innovation in the country with the proposed centers of excellence for artificial intelligence, private sector access to ICMR labs, centers of excellence in pharma research, etc. We are also pleased to see the government's continuity and commitment towards climate action and net zero commitments by giving due thrust to green growth. More details on the simplifications in tax structure, broad consistency in policies, and more measures related to taxation will of course be shared by well-known experts who are on the panel, and of course the presentation Mr. Dinesh Kanabar will be sharing with us later today. Briefly, I would just like to say that this budget focuses on stabilizing policies and reforms and is evident of the continuous efforts of the current government's vision towards prosperous and inclusive India to facilitate sustainable economic growth. And with that, I would like to take this opportunity to invite Mr. Siddharth Nath, Deputy High Commissioner of India and Singapore, to deliver the opening remarks. Mr. Nath, please.
Thank you, Navita. Mr. Dinesh Kanabar, CEO, Dhruva Advisors, Navita ji, Director of FICCI, Singapore, Southeast Asia, Mr. Mahib Gupta, Mr. Neeraj Bagri, distinguished members of the audience, good morning. The outset, just to note from High Commissioner Mr. Kumaran, he was very keen to be here for this very important discussion. However, as some of you know, India's Minister of State for External Affairs, Mr. Muralidharan, is in Singapore today, and High Commissioner had to attend an important bilateral meeting with the Minister. So apologies on his behalf. High Commission of India has been very happy to be collaborating on this webinar on the Indian Union budget for the last few years. And thank you to FICCI, to Dhruva Advisors, to SICCI, to our other partners. We do see a great deal of interest in Singapore, among Singapore investors, individuals in Singapore and the broader region, in fact, for the union budget every year, which is not surprising given that Singapore is the largest source of foreign direct investment into India annually, and a large number of Indian entities, Indian companies have a presence in Singapore and vice versa. A lot of interest on the Singapore side as well. We have with us a very, very knowledgeable and accomplished panel that will take us through the details of the budget and its implications for Singapore-based investors, individuals, entities. I'd just like to make a few points from the broader perspective, as well as from the lens of bilateral relations. So the Finance Minister in her speech identified 7 priorities, which she termed sub-pirishis, that would guide government policy. The 7 priorities are inclusive development, reaching the last mile, third, the focus on investment, capital investment in particular, infrastructure, including railways, logistics, sustainable cities, regional connectivity. Fourth, unleashing the potential of the economy, including through improved administrative capacity and boosting ease of doing business. And in that respect, building on the initiatives of the last few years. Fifth, green growth. Again, a theme that has a lot of resonance in this region, including support for the green hydrogen mission, green transition, green energy storage projects, renewable energy evacuation, green credit program. Sixth, youth power, with a focus on the much needed areas of human capital formation, including skilling and training. And seventh, financial sector, building on the reforms and innovative use of technology for financial inclusion, ease of access to credit in financial markets, simplifying and reducing cost of compliance, some of the themes that we'll hear more of later today. There is also an announcement about data embassies and gift IFC, so new and innovative cutting edge reforms, including the data policy. In short, a large number of policy announcements aimed at promoting innovation in R&D, digital economy, sustainability and climate action, as Navita pointed out, and ease of doing business. The finance ministers underlined that the vision for the Amrit Kaal over the next 25 years includes building a technology-driven and knowledge-based economy with strong public finances and a robust financial sector. The budget has indeed walked its talk. Without going into too much detail, a couple of figures are pretty startling. So capital expenditure, for instance, has been prioritized to address the needs of public infrastructure, along with focused welfare initiatives in crucial sectors, while ensuring prudent financial management. Capital outlay, for instance, has increased by 33% to 10 lakh crore rupees, over 120 billion US dollars, 3.3% of the GDP, and thrice the capital outlay just 2-3 years ago in 2019-20. And in line with the focus on connectivity, the capital outlay for the railways alone is 29.3 billion US dollars, highest ever. The global economic landscape has been challenging for both geopolitical and economic reasons. And in that context, India's quick recovery and rapid growth this year and as projected for the next year is indeed a bright spot. India has already become the 5th largest economy in the world in the 75th year of independence and is expected to reach $3.5 trillion in GDP by the end of March. The stress on inclusive and green growth, along with rationalization of tax rates, also ensures sustainability and public support. The measures for reduction in personal income tax rates and rationalization of indirect taxes also reinforces the measure of ease of doing business and efficiency, productivity, and incentives for higher growth. Before ending, I'd just like to come briefly to the India-Singapore strategic partnership. In the recent India-Singapore ministerial roundtable that was held in September 2022 in India, for which the Deputy Prime Minister Lawrence Wong and other senior ministers had travelled from Singapore, 5 areas had been identified as potentially being ripe for cooperation. Emerging areas such as digital connectivity, fintech, green economy, skill development, and food security. Interestingly, this vision is entirely in consonance with the spirit and underlying themes of the Union Budget 2023-24 and the policy announcements made. I am therefore confident that the Indian budget also creates a conducive environment for further strengthening the trade and investment ties between India and Singapore, quite apart from the dynamism and the impetus it gives to the Indian economy itself. Thank you very much, and I look forward to the discussion that follows.
Thank you, Mr. Siddharthnath. Thank you so much for this overview. And I think connecting it back to how the Singapore and India story is progressing and some of the commonalities that are there, I think those were some very excellent remarks that you brought up in your opening remarks. And on that note, I'll invite Mr. Dinesh Kanabar, CEO Dhruva Advisors. He'll be making a presentation on the tax proposals in the Indian Budget 2023. Mr. Kanabar, please.
Thank you. Good morning, and thank you, sir, for joining us, Deputy High Commissioner. Grateful for your time here. Thank you, Namita, for the wonderful introduction. Every year when the budget is presented, almost all of us become budget experts. We start talking about the economy and how does the finance minister's proposal stack up in the light of what is the current economic environment. And this year again, when I was on CNBC and we were talking about what to expect from the budget, etc., there were two overarching themes which came about unanimously among everybody. One was that India was a bright spot in the global economy, and we'll talk a little bit about it as we go along. And the question was, what is it that the finance minister can do in the budget to ensure that India's spot, the bright spot, is firmly secured? We have heard this as India being an alternative supply chain in the as an alternative to China, as an alternative to Europe, etc., etc. Our own Prime Minister has been talking about how India can be a great alternate manufacturing hub. So what is it that the budget will do towards that direction? That was one issue. And second was in the path of taxes. How is it that one can provide a stable tax regime such that people are comfortable, that there are not too many changes, things are going on the right path, etc. And before I go into the specific proposals, Namita mentioned earlier on that there was a welcoming of the budget, and the reason for why the budget was very much welcomed by one and all was that on both these two counts, which are the two most important counts, the budget measured up quite a bit. Vishal, if you could go to the first slide. First, as a background, we are all aware, and I don't need to stress too much on it, but it's just important as a background that globally, as we talk to our clients, whether in USA, whether in Europe, you only hear of whether there's going to be a mild recession or there's going to be a long recession. People keep on talking about financial crisis. People go on talking about how growth is likely to slow down. And in that context, India continues to be a very, very bright spot. You would come to India and you would talk about whether the growth is going to be 6.2% or 6.8% or 7%, rather than what you would hear elsewhere about how the recession might be hitting you hard or not hitting you hard. A very, very, very stark thing. And clearly the Indian government continues to focus on long-term economic growth. There's been this huge amount of startup economy which has propelled India and got a lot of fundings. We have got medium and small scale enterprises, and government wants to sort of encourage them because that's where entrepreneurship grows. And this year has been a very important year for India because it is leading the G20 initiative. We are the sponsors for the G20 initiative. And again, that has allowed us to showcase to the world what India is all about. So net, that's been one situation. I must also put one other thing, and this is very, very critical. Normally, when the finance minister gets up and presents the budget, the issue is on how do you collect more revenues. So how do you collect more direct taxes? How do you collect more indirect taxes? This year was actually almost the opposite. So month on month, our GST collections, which were almost around 1 lakh crores of rupees, has now gone to almost 1.5 lakh crores of rupees. Very, very robust. And this has been 1 year where our direct tax collection are in excess of the budgeted numbers by 20%. So whatever the government budgeted, they would collect by way of direct taxes. The actual collections are 20%. And we are likely to close the year at somewhere between 23 and 24% higher. So there is a high tax buoyancy. And for a change, the thrust is how well will we spend the money in a manner that promotes growth. So a very, very different sort of an orientation to the budget. Vishal? Yeah. So if you look at the global growth, and this again is known to everybody, India's growth tables or on the table of global growth, India is almost at the top. So if you look at some of the larger economies, clearly, of course, we need to bear in mind that India's own economy has been at a low thing compared to, for example, a USA or China, but our growth has been very, very spectacular. And as I mentioned earlier on, there is this whole debate as to whether India will grow at 6.5% as the economic survey shows, or 6.1% or 6.6%. But whichever way you look at it, we are somewhere around 6%. And the IMF has projected further that for the next year, our growth is likely to be 6.8. And while many of these numbers might mean sort of just flaunting numbers around, in the case of India, really, I would not be surprised if when we end the year, we are almost at around 7%, because that's what we are seeing, really a lot of influx happening, how new companies are coming in, sort of relocating their manufacturing bases. Foxconn, as an example, now has close to 80,000 people in India and is likely to go up to about 300,000 people. So again, a lot of job creation, a lot of wealth creation happening all around. Vishan? The entire macro thrust of the budget was on supporting domestic demand. And as the High Commissioner, Deputy High Commissioner mentioned, really we had huge amount of capital outlay. This is very, very important. Every year, the capital outlay of the government goes up somewhere between 5, 7, 10%. This is the first year where the capital outlay is almost a third more than what it actually was in the preceding year. In contrast, the revenue expenditure of the government is going up by just about 2%. So what the government is saying is, we are collecting taxes. There is a buoyancy in tax collection, but we are not going to fritter that away by sort of paying salaries and sort of incurring expenditure, which does not result in any benefit to the country. 33% growth in capital expenditure, just 2% growth in revenue expenditure. So the entire thrust is that if government incurs this expenditure on promoting infrastructure, doing whatever else, it has to be accompanied without an iota of doubt on corresponding expenditure being incurred by the private sector. And when both of these happen, we're going to see increase in domestic demand. We're going to see really sort of economy flush and economy growing and thriving. Yeah, Vishal. Two other comments I would make without making it too overbearing, which is that there has always been this whole issue about India's tax to GDP ratio, which has been very low number. For the first time in 21, we crossed the double digits. So we have gross tax revenues at almost 10.24% of the budget. That is now going to almost 11%. Again, a very, very welcome thing. So the robustness of the tax and its contribution to the economy is just growing. And again, that's very, very critical to note. Yeah, Vishal. So let's go to the direct tax proposals. The first thing on direct tax proposals has been that, as we are all aware, the tax rates in India for corporates has been fairly reasonable and modest. We have 3 tax rates in India. If you are a new manufacturing company, as a company, you end up paying 15% tax. If you are not a manufacturing company, then you have a choice of paying either a 25% rate of tax or a 35. If you are paying 35, you are entitled to deductions and exemptions. If you choose not to go down the path of getting deductions and exemptions, many of which could lead to a lot of litigation, then you end up with 25% tax. So on the corporate side, what we have seen from our experience is that almost 80-90% of the companies have moved to the new tax regime, which is the 25% tax regime, which is very, very welcome. On the individual side, again, the government has been trying to say that rather than allow people to make investment in insurance policies or put monies in pension and claim it as a deduction, why don't we, like corporates, have 2 tax regimes? One where you are encouraged to pay a lower rate of tax and decide how you want to make your investments, how do you want to plan your savings, etc. Other is where you pay a slightly higher rate and are also entitled to certain deductions and exemptions. And unlike in the case of corporates, where most corporates opted for a 25% tax regime, in the case of individuals, they opted for a higher tax but wanted deductions and exemptions. And the government wants to move people away from a deduction and exemption regime to a simple tax regime. So the government has said that going forward, the concessional lower rate of tax regime will be the default regime. You still have an option to opt for the higher tax regime and claim deductions and exemptions. But what the government has done is to put 3 proposals for individuals. First is they have enhanced the threshold at which you start paying tax. They have reduced the rate of taxes intermediate, and the maximum marginal rate, which was a little bit unconscionable, unlike in the case of corporates, the rate is as high as almost 43%, has now been reduced to 39%, almost a 4% reduction. But all these 3 changes, all these 3 benefits will be available only and only if you opt for the new tax regime and not the old tax regime. So clearly the government is saying, don't go down deductions, exemptions. We would like to have more money in your hands. And then you decide whether you want to invest in a ULIP, you want to invest in mutual fund, you want to invest wherever banks, etc. We leave that to you. Rather than we encouraging you to invest in life insurance policies, etc., and give you deductions and concessions for that. It's a matter of time before you start seeing almost everybody move to the individuals, also move to the new tax regime. A very, very welcome thing. I think most important, the reduction of the maximum marginal rate is very, very important, very, very critical, and should really speak good about the fact that at a maximum rate, as an individual, you end up paying 39 and not 43% rate of tax. Vishal? So this is how the taxes now compare. What was the old taxes? What are the new taxes? So the moment you go to higher income slabs of 2 crores and above, if that's your income in India, then you go on getting more and more benefit. So clearly at a 7 crore, it makes a very, very material difference in tax, primarily because of the fact that the maximum marginal rate has been reduced. And again, as you go on progressing, you find more and more incentive to go to the new tax regime as opposed to the old tax regime. Yeah, Vishal. Many, many other proposals and very interesting proposals. And we'll just illustrate to you how the government is looking at taxes in a very different way compared to how it used to look at in the past. So the first proposal is that if you opt for high value insurance policies, where your annual payment by way of premium is more than 5 lakhs of rupees, and if those policies are issued after 1st April 23, then when you get the monies back from the insurance company, you will have to pay tax on it. Very, very interesting. And there's been a lot of discussion and debate around this, and I totally support the proposition. Because what we are finding today in India is that insurance companies are selling insurance policies as not life insurance policies, but as savings product. Now, if you are having a savings product and what you are getting back by way is interest, then if you're keeping the money in a bank or elsewhere, you would have to pay tax on it. Just because you disguise an insurance policy as a sort of an investment policy, how can you escape taxation? And clearly, this has had an there is one estimate that almost 80% of the insurance policies are really by way of savings policies as opposed to really life insurance. Again, a sensible exception has been carved out that if a person is not alive and his or her heirs get the money, there is no tax liability. But if you get the money back, then clearly it is in the nature of interest and you end up paying taxes. Another very, very interesting proposition, which is on capital gains. So today the law permits that if you sell a house and buy another house, or if you sell shares and buy a house, subject to the fact that you don't have two houses, etc., then the capital gains which are reinvested in the new house is totally tax-free. And the government came back to say that, look, this is meant for housing. This is not that housing becomes an investment mode of investment again. And therefore, they have put a cap of 10 crores of rupees to say that capital gains exemption will continue, but only to the extent of 10 crores of investment. If your investment is beyond 10 crores, then you do not get capital gains tax exemption. Again, a lot of debate, lot of discussion around this. One representation which we as Dhruva have made to the government is that we support this particular proposal insofar as it concerns other than a house. So if, for example, you've got equity shares, you sell them on the market, you can buy a house and 10 crore exemption looks reasonable. But if you are substituting a house for a house, and just because the value of your house has gone up very, very significantly, that restriction ought not to be there. Let's see when the budget proposals are finalized, whether that suggestion is heard or not heard. But again, just shows the trend of the government to say tax exemption should serve the purpose for which they are, should not be used as a means of planning. Yeah, Vishal. Two other interesting propositions, both again very, very worthy of note, not for the proposal itself, but for the approach of the government. We had a very interesting judgment by the Supreme Court many years back in the context of computation of capital gains. So capital gains, as you know, is computed by taking sale price of an asset as reduced by the cost and cost of improvement of an asset. And the Supreme Court was faced with a very technical argument that if a acquisition cost was nil, or it could not be determined, then can you pay capital gains at all? Now, absurd as it may look, Supreme Court held that if the cost of acquisition of an asset is nil, or you cannot determine the cost, then no tax is payable at all. Actually, it should be that the full tax is payable, but the Supreme Court said no. Then the law went on getting amended to say that certain types of assets, even if they don't have a cost, the cost will be regarded as nil and you will have to pay tax on it. And people went on sort of tampering with that, different rights, non-compete, manufacturing compete, whatever else. And finally, the law has now been amended to provide that any asset which is an intangible, if it has cost you nothing, the cost will be regarded as nil and you will have to pay capital gains tax. Just to show that you can't go on messing around with law and find innovative ways which chartered accountants tend to do and sort of try and avoid taxes. Just plug the loophole and get on with it. Online gaming, there is a withholding tax which has been proposed, very important because the government has not been able to sort of gather taxes and determine who is the person who is liable to pay taxes towards the end of the year. A withholding obligation will ensure that the person who's making the payment will deduct taxes at source. Yeah, Vishal. This is one provision which has evoked a lot of controversy and where I think the government is wrong. And again, I had the benefit of discussing this with the finance minister, revenue secretary, etc. And I have been assured that they are reconsidering this provision. So as you know, in case of REITs and InvITs, and I will not be too technical here, but just to explain broadly, assets are transferred for REIT and InvIT, and they are then vested in a special purpose vehicle. And the way the accounting of that happens is that it's the amount payable for the asset is treated as a loan. And when the loan is repaid, the question was, is there a tax liability or not? And the provision essentially says that any payment received back from a REIT or InvIT will be fully taxable. And indeed, it is required to be taxed. I don't think there is any doubt on it. The question was, should it be taxed as normal income, liable to tax at a higher rate, or as capital gains? And what is provided in the budget is that it will be liable to tax as normal income. A representation, several representation, dozens of meetings have been held, and the government seems to be inclined to accept that it should be taxed as capital gains at a lower rate and not at a normal income. But this is very, very critical. If this provision is not amended, it might really impact the REIT and InvIT industry, which has taken good shape after years and years of effort, and the government should not fritter it away. Yeah, Vishal. One very interesting proposal is that when monies leave India, whether it is by way of overseas investment, medical expenditure, education, travel, whatever else, sometimes the government felt that this money was not accounted, although this goes from the banking channels, but it is not accounted. And because it is not accounted, the question was, how does the government track it and ensure that what has left the shores of the country is accounted money and not a shadow economy? And the government, therefore, a couple of years ago, introduced a provision that anybody making any remittance overseas will pay a 5% tax, which is not actually a tax because what is sent out is not income. It's actually an expenditure. However, this 5% which is recovered from you at the time of remittance can be set off against your tax liability. So what we call as collection of tax at source. What is now proposed is to enhance this rate from 5% to 20% for any remittance overseas other than by way of medical or education. Apparently, the government believes that it is still not able to track unaccounted money, and a 20% tax will sort of ensure that appropriate taxes are collected. My concern, big concern, which again I have shared with the finance minister, is that such a high steep TCS, which actually is not an extra tax because you can set it off against your normal tax, but that might really promote what we call as hawala trade. But let's hope where does this go. The next change is with regard to market-linked debenture, and again shows the government's intention of taxing the substance of the transaction rather than the form of the transaction. So market-linked debentures are debentures which are issued by companies. They are listed on the stock exchange. And again, as you know, if you have got any security which is listed on the stock exchange, you hold it for a year and then you sell it, then the gains are long-term capital gains taxable only at 10%. In the context of market-linked debenture, the reason why you made a gain was the inbuilt interest and nothing else. And so here was a situation where interest, instead of being taxed as normal income, was being taxed at a concessional rate, which is applicable to capital gains, only because the assets were listed on the stock exchange and a lower rate was provided. This loophole has been plugged, and it is now provided that any gains on market-linked debentures will be taxed as short-term capital gains and exigible to full tax. The next change is on angel tax, and again is a bit of an issue which I'm worried about, a change which I think could create a couple of bad situations, bad precedences. That when the government introduced angel tax, the proposition was that startups have high value. They are able to get investments from venture capitalists, private equity, but those are also used, so to say, for money laundering. So one does not know whether the monies which are coming in are genuine, what is happening out there. And therefore, the proposition is that if you make investment in a startup or any company and the value of the shares is not justifying the premium which has been paid, then the balance is treated as income. Now, when this proposition was introduced, overseas investments were kept out of it. Now the coverage has been expanded to monies received from non-residents too. In itself, the proposal would not have been a challenge. The challenge is that valuation is a very, very difficult proposition. And the government goes on challenging valuation at a ground level to go back and say, prove that this is a right value or not. And again, as we say, like beauty is in the eyes of the beholder, value is in the eyes of the beholder. And unfortunately, the expansion of this coverage to overseas investment will again increase litigation on the front. Yeah, Vishal. A startup investor, you can skip that. Let's move on. Again, some changes, very fine tuning. I don't think I need to get into all of that, but really shows that the government is going on plugging loopholes. One very important, interesting thing is that when tax is deducted at source, you get credit for the taxes which are deducted at source in the year in which income is reported. There are times when the person deducting the tax deducts it at a different year and income is accounted in a different year. What is now facilitated is that you, even if there are two different years, you are entitled to get credit for the taxes which are withheld at source. Yeah, Vishal. Sorry, Vishal, just can you go back? Just one comment here. Very interesting. This is on medium and small scale enterprises. The government was very keen to ensure that these companies do not suffer from liquidity crunch. And therefore, a very interesting provision is that if you have any expenditure for which payment is required to be made to a medium and small scale enterprise, you can deduct it only in the year in which you have paid it. And therefore, one can quite see that come 31st March, everybody will want to ensure that they make payments to MSMEs and not keep it for outstanding for a long, otherwise they won't get a tax reduction. Yeah, Vishal. Interesting provision on non-banking financial companies. So non-banking financial companies generally have got a wide base of shareholders, venture capitalists, private equities, etc. And not only do they have shareholding from these entities, but they also borrow from these entities. And it was becoming very difficult for them to comply with thin capitalization rules, which allowed you deduct interest only up to 30% of EBITDA. So non-banking financial companies are now being excluded from thin capitalization provisions. Yeah, Vishal. So those were the key direct tax proposals. If I can now invite Neeraj to come and talk about the indirect tax proposals. Neeraj, the floor is yours.
Thank you, Dinesh. Vishal, if you can, yeah. So I will take up the changes made under the customs law first. If we see the theme of changes which are made, they are broadly into buckets. One is, in last few years, the changes in tax laws, especially in customs, has been made with a view to promote a Make in India. And therefore, we have seen various rate rationalization measures where the rate on the raw material inputs has been brought down, and the rate correspondingly rate on the finished goods have been increased with a view to ensure more localization of manufacturing of goods in India. Therefore, we have seen various rate rationalization measures to promote domestic manufacturing, especially in the area of green energy, which has been the focus of this government. Again, we have seen benefits of project import not being provided to a solar power plant project. Again, the idea is to promote more and more domestic manufacturing. India has a target of achieving 30 gigawatt of solar energy production by 2030. And therefore, there is a thrust on, having more manufacturing facilities for solar modules, solar cells in India. And with this intent, the idea is to have more and more people come set up factory in India to manufacture these products. The second leg of changes are more administrative, with a view to reform the customs area, customs notifications. Previously, we had notifications which were issued which did not have an end date. So we have these long list of notifications which were there for last 15, 20, 25 years. Most of them may have become irrelevant as nobody would have really applied their mind to see whether they serve any purpose in the current times. So what the government did was to introduce a law couple of budget back to say that any customs notification issued will have an automatic expiry of 2 years unless it is specifically extended. So now what the realization has been that certain exemption notifications ought not to suffer this automatic expiry because they are more long duration in nature, and therefore they should not invite an automatic expiry of 2 years, and they have carved out an exception. So customs notification issued under the free trade agreements which are of long duration nature, schemes under the foreign trade policy relating to advance authorization, EPCG, etc. So all these notifications now will not expire within 2 years, and they will continue to be operated till the time it is not rescinded. Vishal, next slide. The other changes which I will take up are relating to goods and service tax. Now, goods and service tax law, as we have seen in last 5 years, have seen various changes that has been made from time to time, looking at the representation that has been received from the industry. And the tax collections have gone up significantly, as Dinesh mentioned in the initial opening remarks. The average tax collection is close to 1,50,000 crore monthly, and and it's ever rising. And the government is looking at various areas to ensure more compliance, which will lead to higher, healthier tax collection. Now, some of the key changes which have been made under the GST law are the amendment made to the definition of online information database access retrieval services, which is basically a tax applicable on services provided through use of information technology. So you have various services like online gaming or e-books which are being downloaded from the net, etc., which are covered in this category. So to remove certain doubtful interpretation and inconsistencies, changes have been made in the definition. So earlier, the definition provided that if the services are largely provided through information technology with a minimal human intervention, then that will be categorized as an OIDAR service. Now, the use of the word minimal human intervention was leading to an interpretation issue as to how do you really define what is minimal, what is more than required, etc. So the government has amended and proposed to amend this definition to delete a human intervention. So irrespective of the degree of human intervention, now they will get covered within the meaning of OIDAR services and accordingly may be subject to tax. A welcome change has been made by making a retrospective amendment to provide a benefit to certain transactions like merchanting trade, basically when goods are being sold out and out of India without touching the customs frontier, as well as goods which are sold in custom bonded warehouse and high sea sales. Now, these transactions were categorized as transactions which will not be subject to GST, and this amendment was made in 1st February 2019. There was a lot of discussion and debate that whether the amendment that has been made should be read as clarificatory. Thereby, the benefit should be available right from the day the GST law got introduced, because there is no intent to levy any GST on these transactions. What the government has done is come out and made a retrospective amendment, therefore removing any doubt whether the benefit of no tax on such supply should be extended or not, providing these transactions with the cover of no tax being applicable right from the day when the GST got introduced. Along with the amendment made for not taxing these transactions, one amendment has been made specific to inbound sales, basically goods which are sold after they are imported into India, but they are lying within the customs bonded warehouse. That is before the bill of entry is filed for home consumption on payment of customs duty. So technically, these goods are lying in India and they are not being subject to GST. So to provide a level playing field for transactions, which are being done as if it is an exempt transaction in India, the law is proposed to be amended to deny proportionate input tax credit for such inbound sales. So this will be treated at par with an exempt transaction, and ideally the credit which are directly attributable will not be available, and the common credits will suffer a pro rata reduction, which is again at par with what an exempt transaction should be. The another change that I would like to talk about is relating to CSR expenditure. So as we all know, all Indian limited companies have to make an expense, which is 2% of the profit towards corporate social responsibility expenses. And the question was, when these expenses are being incurred and the supplier is charging GST, whether the company could have availed the input tax credit on such transactions. There were several judicial decisions which have come supporting the viewpoint that these expenditure is being incurred by the company for the purpose of compliance of a statutory obligation under the Companies Act, and therefore they should be regarded as expenditure incurred in the course of business. To overcome these decisions, an amendment has been made to disallow the input tax credit for the expenses being incurred towards a corporate social responsibility. Now, one way to look at it, it could be seen as something, a setback, because companies will not be allowed to claim the input tax credit. Another way to look at it is also possibly, the 2% limit which was being applied. If the companies would have taken the input tax credit, then naturally that would not be considered as part of the cost within the 2% limit. Now that the GST credit is not available, they should be considered as part of cost, and therefore the 2% limit to that extent will also cover the GST cost. Then there are changes again, which are, rationalization of penal provisions. We have seen the finance minister talk about decriminalizing more than 39,000 offenses under various enactments. And again, under the GST law, a law being at a nascent stage, the idea was not to criminalize several category of expenses. So we have seen changes relating to decriminalizing of various offenses under the GST law. So these were the key proposals, key changes which have been made under the indirect taxes in GST law.
Mahip, we have a few questions which have come up, which have been sent to us. Maybe we can discuss some of them and then take it forward from them, Navita.
Yes, Dinesh. In fact, I was about to invite all of you. Some had some technical glitch, but glad that you could take over. And the idea is, of course, to have a few discussion on the overall macroeconomic and business perspective of the budget. And I believe you already have some questions for all of us. So Mahip is already with us, Neeraj is with us, and I would like you to lead, Dineshji, and lead the discussion and lead the session on this discussion. Yeah.
So I could just first begin with Mr. Siddharthnath. Sir, we discuss about the proposals in the budget, etc. And sitting in Singapore, you spoke about India-Singapore ties and how they are so very robust. My question for you, sir, is that how are you seeing ease of business in India? What are you seeing as challenges and what are you seeing as opportunities? He just put his video. Mr. Nath?
There may be some technical glitch, Dinesh.
Maybe, yeah. So, Mahip, why don't I turn to you? One important change which did not happen in this budget and which is causing a bit of a concern is that there is this section 194 LD which speaks about a 5% withholding tax on foreign currency bonds. So that 5% was a concessional rate. External currency borrowings became very attractive. And that regime has now not been renewed. It was there for many, many years. What are you seeing as an impact of that?
I think impact will be in terms of the increased borrowing cost, especially from the foreign investors into India. So the next best rate after this 5% domestic tax relief has been removed would be the India-Singapore tax treaty rate, which for financial institution is 10%, vis-a-vis non-financial institutions, including funds, it will be 15%. So that certainly increases the 10% of the interest cost. So in today's date, if you have the interest of around 10%, that will stand increase to 11%. Having said that, if you look at the macroeconomic situation, the rate of interest locally in India have not kept pace with the increase in the rates in US dollar and other currencies across the world. For example, US dollar rates have increased by close to 4%, whereas Indian domestic lending rates have increased in the region of 1 to 1.5%. So this may be an intended move, given that Indian borrowing cost remains competitive, and to further give impetus to the Indian capital market, Indian lending, on the top of the gift city, which Indian government is promoting, which provides for a lower withholding tax rate of 10% for the investors, vis-a-vis 15% from Singapore. So all these factors can be considered by investors to, kind of relook at their borrowings or their structures. Other area where, some of the investors in the past have reduced the borrowing cost is by investing into the debt which is denominated in certain low interest currencies like yen, where you can keep the interest rate low, and the forward premia which you will enter into separately to cover for the forex risk can be then hedged, and that hedging cost is not subject to withholding tax.
Mr. Nath, we lost you, and I wanted to begin my question with you to say that sitting in Singapore, you are looking at how India-Singapore trade is evolving, and we spoke about ease of doing business. How are you seeing the various initiatives which have been taken by the government on the ease of business side, and what more do you think needs to be done?
That was addressed to me.
Yes.
Yeah. So yes, indeed. So we do see a great deal of enthusiasm for ease of doing business for the proposals that the government has brought in. There has one issue that one sometimes hears is that while that there are differences between different states, that one has to make sure that the ease of doing business, that philosophy trickles down to all levels of the federal system. So I think that is something, a lot has happened. There is a new competitive spirit that we see among different states as well, because attracting foreign investment is something that everybody is competing to do. We see a lot of new initiatives in different states, global investor summits happening, a lot of delegations coming out to places like Singapore, and that's given them an opportunity to hear firsthand what are the bottlenecks that investors are facing. So I think that's all, the change in environment has been very positive, and we just need to keep that momentum up. In that context, it is very useful. You've also flagged in your presentation a few issues that could cause concerns. I think all these are very useful feedbacks that go back to the government, so that as and when policies are reviewed, as and when implementation is looked at, we make sure that the message is consistent with actions on the ground. So thank you for flagging that.
Neeraj, you mentioned, and we saw about how GST collections have been so robust, etc. And clearly, after the initial hiccups, GST has settled down. Thanks to GST, we have seen a lot of monies flow into the formal economy. Today, it is recognized that being outside the tax net is almost impossible, become very difficult. How do you see the future of GST, and where do you see changes coming?
Sure. So as you rightly mentioned, you have seen GST law settling down, the extensive use of information technology to garner information, harness and use data analytics to find where the tax leakages are. So we have seen the tax leakages go down significantly by curbing the use of fake invoicing, denying fraudulent input tax credits, etc., which has resulted in large tax collections. Now the government is looking to also, go in other directions apart from the information that is being collected through filing of returns, looking at the data of electricity, consumption to identify areas where tax is not being made, looking at property records. So I think the government is looking at various innovative means to again, ramp up the tax collection without increasing the rates by broadening the tax base. In fact, one of the important proposals being discussed is, where the government has identified that the last mile connectivity, the issuance of invoices by business to consumer is one of the areas where probably there is a tax leakage which is happening. So they are looking at, let's say, incentivizing, citizens to ask for a tax invoice by having a lottery system rewarding them, thereby encouraging compliance, which will definitely help in increasing tax collections without increasing rates.
Thank you, Neeraj. Mahip, coming back to you, you sit in Singapore, you advise on regional taxes, you're seeing what's happening in Vietnam, you're seeing what's happening in Philippines, you're seeing the entire region. How are you seeing investors approach India? And what do you think does India need to do more in this direction?
So, Dinesh, on that respect, India has been of late doing quite a bit in making it easy to do business in India by removing various windows for the clearances. In many areas, they are also introducing single window of clearance. I think India has to just keep up this pace and learn from the best, including Singapore, as to how we can keep further reducing the entry barriers for the businesses who are abroad, who are not so familiar with the Indian environment. For example, we have, like in Singapore, Enterprise Singapore and ADB, which helps investors coming to Singapore familiarize themselves or the entrepreneurs with the Singapore market, connect them with the ecosystem. So we also need to bring to the fore such enabling agencies in India who can help soothe the nerves of the foreign investors who have not been into India and being able to assimilate into the Indian system much easier.
Mr. Nath, is just a follow-on question for you. The Indian government has introduced PLI, Production Link Incentive, which has been a very successful initiative, sort of in trying to see that manufacturing base sort of shifts to India, increases in India. How are you seeing the response of Singapore entities, etc., on this? And where do you see, what more do you think the government needs to do?
Thank you very much. So before I come to that, if I can just continue also where Mahip left off. So that's a very interesting point that he made. It's true that Singapore has been very efficient in enabling agencies. The good news is that in India also now we do have Invest India, which is stepping up to the plate, providing a sort of cradle to grave kind of, not grave hopefully, but cradle to adulthood kind of service. So Invest India is doing pretty well, and we've seen a few good examples of investors from Singapore and the region who've spoken very highly of how they've helped, whether it's with land acquisition, dealing with local partners, helping get regulatory approvals. And we also have similar agencies now coming up in states as well. So during the recent visit to Singapore of the UP delegation in preparation for the UP Investment Summit, we saw that they've also professionalized their enabling agencies. We have Tamil Nadu having a similar system, Maharashtra as well. So there's an understanding now that foreign investors are looking for much more dynamic assistance, and we're seeing states doing that. You're right on the PLI scheme, particularly on the electronic side. There's been a lot of early successes, though we have to, it's helped us foster interest. But I would also like to point out that even beyond, companies who are not in the PLI scheme are also reporting increased investment, particularly in the current geopolitical situation and the rapid strides that India has made in terms of improving ease of doing business. There are a few, there is a window of opportunity here. The budget itself goes a long way in rationalizing some of the structures. So hopefully we will see a continuation of this trend. I think we've only reached, it's only the tip of the iceberg that we've seen. From what I've heard, there are very large investment plans. Many companies, especially in some of these new areas, semiconductors, smartphone manufacturing, things that are high-tech but also are on a sufficiently large scale, take advantage of the skilled manpower that we have in India and the enabling environment. So I think it's looking good right now. We just need to continue.
Mahip, again following up on our earlier question, how do you see the continuing role of Singapore as being a hub for investments into India? You also spoke about Gift City and how India has been trying to develop the Gift City. How do you see the interplay between Singapore and the Gift City?
Yeah, Dinesh, that's a very good question. In fact, 5 years back, of course, India-Singapore tax treaty was revised to exclude the capital gain exemption. But many doesn't know that capital gain exemption has been removed only for the equities. And it still continues for various other class of instruments, including compulsorily convertible debentures, non-convertible debentures, as well as derivatives. So many of the FPIs are still, routing their investments from their Singapore hubs because they can enjoy the benefits on the debt trading as well as the derivative trading. And similarly, the FDI in certain cases have been structured tax efficiently. And more importantly, going beyond taxation, taxation element is just one minor aspect in the overall scheme of the investments, because even if where the capital gain tax applies in the long-term cases, it is hardly 10%. Beyond taxation, Singapore is considered to be a very robust legal as well as financial center, which gives the confidence to investors to root their investments from Singapore, apart from just being India focused, which certainly is a very large economy. The regional hubs here are investing into various regional economies, including Vietnam, Indonesia, Thailand, Malaysia, and beyond. And Singapore still continues to be very, very tax efficient holding company jurisdictions for these countries. And for them to have this diversified portfolio of investments and the headquarter regime for all these locations plus India makes a lot of economic sense as well. And vis-a-vis Gift City, in fact, many of the investors from Singapore are considering investing into the Gift City, to take advantage of various tax exemptions are being offered by Gift City. So there's a good interplay. Rather than Gift City acting as merely a competition, it is supplementing the plans of the investors based in Singapore.
I think those were the questions that we had. Maybe we can have a closing round of comments from all the people on the call and then close this.
Sure.
Surely. So would you like to start off, Neeraj? Do you have any closing comments before we end this session? I'll go with Neeraj, then Mahip, Siddharth, and Dinesh towards the end.
No, I think, so far as, the budget proposal go, again, that's a continued theme that we have seen in this budget, focus on Make in India, rationalizing measures and, affecting, provisions which will enable tax collection and without, increasing rates. So I think that is a trend which we see likely to continue in future, which will have a sort of a more definitive tax regime and a more stable tax regime is what we feel is likely to continue in the next few years.
Now, I would like to add that with the, in the entire globe, the diversification of the supply chain is the focus. And India represents a great opportunity, a very cost-competitive economy to offer, to the multinationals to base their operations there and diversify their supply chains, both in terms of the products as well as services.
Siddharji, would you like to make a closing comment?
No, just to thank all the eminent panelists for the excellent presentations. I think they brought out all the salient points of the budget in an excellent way, and we continue to look forward to collaborating with all those on this call to advance this agenda forward. Thank you very much.
Thank you, Siddharji. Dineshji, would you like to make any closing comments?
Yeah, all that I would say is maybe a little bit of a repetition of what I mentioned earlier, that as I talk to my clients globally and all foreign investors, India is a bright spot. This budget will act as a catalyst in sort of trying to ensure that we achieve our potential. I think we have dynamic leadership within the country at all levels. And we are seeing policies which are walking the talk. As we discussed earlier, the capital expenditure outlay increased by a third is, I don't think, what very many countries can talk at all. Recently, for example, we saw the Aero Show where we announced about Air India purchasing 470 aircrafts. Now, it's apart from the fact that it's one of the largest orders in history, it just shows the mindset of the government. Here we were having a national carrier which was sort of bleeding, putting it in the hands of a private company, and then ensuring that you are doing the best things to make that private company become probably the largest in the sector. I think that's the change that we are seeing. And that's the change I would want your participants to be cognizant of. And sort of when they are dealing with India, that we're dealing with a new, robust economy, which is self-propelling and which has a potential of going very, very far.
Thank you, Dineshji. Are you able to hear me?
Yes.
Okay. So just to kind of supplement what all your experts have already shared, and I think from FICCI's perspective, I would just like to add that we at FICCI feel that the overall union budget has actually reflected a very nimble-footed and agile approach of the government to keep India's growth story going. Consistency and commitment are two critical levers of success, and FICCI lauds the government for staying earnest on both of these, positioning India as a growth engine for the world. And from the Singapore perspective, if I were to just quickly add on to the aspect what we were earlier discussing as well, more from the financial services and the gift city perspective, I think the budget has very clearly shown that financial services, of course, is one of the 7 priorities in the budget. And the focus has been on ensuring financial inclusion at scale. And some of these new proposals, such as the setting up of the National Financial Registry, steps for simplification of KYC, access to a wider set of documents in digital locker, and setting up of credit public infrastructure, I think these will provide a further boost and enable the players to better serve the underserved markets. I mean, this is a very important area of engagement, I'd say, from the Singapore perspective as well. And similarly, government's initiative going ahead and enhancing adoption of Gift City by setting up of a single window registration mechanism and also permitting IFSC banking units of foreign banks to undertake acquisition financing. I think all these should encourage a lot of foreign investment participation in the Gift City as well. I'm sure these are things which are of quite an interest from the Singapore investors' perspective. And broadly, I think it's been a very positive budget, and we are all hoping that India's growth story will continue with the current government's support. And on that note,
You're gone muted. Navita, you're gone muted. You need to unmute, Navita.
Yeah, I'm so sorry. Yeah. So I was saying on that note, I would like to thank all of you for joining here today, Dhruva for organizing this session, High Commission of India for always supporting this budget session on an annual basis and making it a success, and to our audience across Singapore, Hong Kong, and the region who have taken their time out to join us today for the session and listen to the perspectives. And before we end the session, I would like to request the tech team in the background to take a group picture of all the panelists present here today. So just give us a good smile and let's have a quick group picture before we wrap up the session. I hope we are done.
Thank you, everyone.
Thank you, everyone.
Thank you.
Bye.
Bye.